It's Thursday, August 8th, and this is Markets Daily, hosted by me, Jen Sanasi. On this show, we navigate the currents shaping the crypto markets, providing insights against the broader financial landscape. So, whether you're actively trading or simply fascinated by the volatility of the crypto markets, this show is your compass to understanding what's happened, where we are, and where we're going. Good morning, everyone. Today's guest is here to talk to us about what's going on a macroeconomic level. Chief Economist at ADM Investor Services International, Marc Ostwald. Welcome to the show.
Hello.
Well, Marc, I've been waiting to speak to an economist all week. We, of course, saw a big market downturn on Monday. Some were saying a reaction to the jobs report here in the U.S., coupled with some developments in Japan. Talk to me about what you're seeing and what we should be watching.
I think what one has to understand is this problem's been brewing for months. You've seen it in the complacency in a lot of trades. You've had the skew that everyone's got in their portfolios towards the AI and the tech sector. I can understand all of that, but there comes a point when valuations just go, out the window. I mean, I think it was Warren Buffett the other week who was basically talking about divesting some of his Apple stake because he just can't see the business case for a company being on a 40 PE ratio. It's not that it's not going to do well. It's just the valuation is too much. And then on top of all of that, we have this problem with Japan, and Japan basically getting off the zero interest rates that it's had basically for the last 25 years. And it was always going to be a tortured process. They decided, having signaled quite clearly quite some time ago, but without enough conviction to warn investors about the potential disruption, that they were going to raise rates. It took everybody by surprise on Monday. I think the surprise was really simply because people didn't really believe that they were going to do it. And that's really what caused, it has caused a lot of the disruption. The combination of very skewed positioning and a good deal of complacency and a lot of leverage in the market. Well, when it happened, in conjunction with the fact that they made it very clear when they raised rates last week that basically their primary concern at the moment is the yen, and therefore the market basically playing long, short yen and long any other asset that you care to think of above all tech was always going to be vulnerable, and that's really what upset the apple cart. I think the fact that it's happened in August, which is traditionally quite a thin liquidity month, probably exacerbated a lot of the move. But what they had been waiting for then was sort of post hoc. After they raised rates, they then had the wages data, which everyone had vastly underestimated. They have jumped enormously, and that offered the big backward justification for what they did. Nevertheless, having raised rates, everyone, particularly in Japan, is actually blaming the Bank of Japan for making the move, even though actually it's as much the Ministry of Finance as it is the Bank of Japan.
Why didn't people believe that there was going to be monetary policy tightening in Japan?
Because they've been so tentative about it. When they first raised rates, which wasn't really much of a rate hike back in April, going from minus 0.1 to zero range to 0 to plus 0.1, they didn't actually, they said, well, depending on what happens with the wages, depending on our judgment of how inflation turns out, and whether we're actually in what they would call a virtuous inflation cycle, basically meaning where inflation stays around their target of 2%, which they share with a lot of other central banks. And they just didn't have the conviction. And at that point, that's when the carry trade really got into full swing, because people went, they don't sound like they're convinced. And then some of the domestic economic data has not been particularly convincing. Household consumption has contracted for 4 quarters in a row in Japan, and everyone's saying, well, why would they want to raise rates? So To a certain extent, they're victims of their own initial success, because what one has to understand is this is a process which started 18 months, 2 years ago. And the first part of it, which everyone was really fearful about, that it would actually create a lot of flows back into Japan, a lot of unwinding of carry trades, was managed so well with so little disruption that people thought, well, they seem to have this all under control. And obviously they didn't. And a lot of it boils down to what a lot of central banks have focused on, particularly in the last 10 to 12 years, is about communication.
Hmm. You mentioned something at the beginning of the interview I don't want to skirt over, is that tech stocks and AI could be overvalued. Crypto really tracks tech stocks these days. We talk a lot about AI. It's becoming a little bit more closely intertwined with Bitcoin mining companies. When you look at the tech and AI sector, it sounds like you're saying it's overvalued and we're due for a correction.
Yes, I mean, I think what one has to understand about AI is there is a big, bright future. But we've got into a very similar situation to the one we did in 99, 2000 with the bursting of the tech bubble, that people assume that it's going to yield results very quickly. And what we've got now is a situation where if you had all the corporate earnings coming out and anyone said we've got an AI project, everyone went, oh right, let's revalue that stock by 10%. It's expensive, first of all. And we've got to this point now where just saying you've got a big AI project and then in the next quarter results, we're going to spend even more, which initially is greeted well because it sounds like you're really being serious about it, then gets to the point where investors say, yes, but what costs are you saving? What efficiencies have you made? How is this going to improve your profits? What's your return on investment? And suddenly everyone wakes up to the fact that at the moment, all it's doing is increasing costs and the returns aren't that great. So we have to have a bit of a reset. And that's where the valuations become extraordinarily challenging. I don't think, the enthusiasm for AI is going to go away, but I do think people need to have more realistic timelines at when companies basically can give their quarterly reports and say, yeah, well, our AI project has meant that we've made these cost efficiencies, where our profit margins have improved by X, Y, Z, and we're just not there yet, largely because where AI is, if one compares it to human development, is it's learning to crawl. It hasn't even started to walk, let alone run. And I think basically a lot of the valuations with AI were at the running stage.
Mm. Based on what you're saying there about AI and in relation to tech, are there any assumptions or predictions that we can make about the crypto markets?
Um, well, the crypto market's at an interesting juncture because I think it should benefit. If we are going into a rate cutting cycle in the US and more broadly, some of the other countries have already started cutting rates. That should be generally quite beneficial. It's not got such hot competition, which, to be honest, crypto has weathered the storm of higher interest rates that we've had over the last 2 years actually pretty well. Obviously it came down with stocks in 2022, but pretty much everything had a bad year that year. Bonds had a bad year, stocks had a bad year, crypto had a bad year. That was just basically people getting used to this idea that, yeah, you can have interest rates up at 5%. They're not particularly high if one actually, someone as old as me, I remember when US long bond yields below 7% were considered to be almost uninvestable. So it's there. I think the most important thing for crypto now is it's become institutionalized. It is
Hmm.
that institutional involvement which gives it a lot more gravitas, not necessarily removing the volatility, but it gives it a lot more gravitas and the idea that people take it seriously. And it
Hmm.
also has the advantage that with gold as not overvalued, but performing so well, it's another alternative in a world which is still beset by fiat money, and where the fiat money is basically still looking for better returns.
Well, I want to talk a little bit more about that. There are people who are in two camps when it comes to Bitcoin. There are folks who are in the camp that Bitcoin is a risk asset. And there are people who are in the camp that Bitcoin is a store of value, much like gold. People call it digital gold. Uh, what's your perspective, if you have one, on Bitcoin? Do you think it follows the risk asset camp, or do you think we're going to start seeing more folks start to view it as digital gold?
I don't think it's got to the stage where it could be viewed as digital gold. I think it is very much still a risk asset. But we're in an environment where we are going into lower interest rates, um, and also an environment where probably the equity markets all need to revalue down to more realistic levels before they can rally again. It presents an interesting alternative, as long as one has the patience and does the due diligence on it.
Now, that market downturn on Monday had economists debating whether we are heading towards a recession, whether we're not. I saw some good arguments on both sides. Where do you stand?
I if there is going to be a recession, I doubt I doubt it happens before next year. For the U.S. economy, for the time being, I think the biggest risk for the U.S. economy actually comes from the fiscal side, from the election. If Mr. Trump and indeed the Republican Party outlines on what it plans to do to the Inflation Reduction Act, which is basically revoke it, that will slow the US economy quite dramatically, because that has, along with the CHIPS Act, has been supporting the economy, been supporting business investment via the tax credits for the past 18 months. And without it, as much as people are also worried about the size of the budget deficit in the United States, but without it, basically that support, you've had the reduced support for the consumer post-COVID, and now reducing that side, I don't think actually would do the US economy many favors, and there would have to be basically a slowdown, and probably a lot of businesses will be quite concerned about what happens next.
Hmm. Along with calls for that recession, I've heard many economists saying that we're due for a black swan event, maybe to kick off that recession. Curious if you think we would see a black swan event seemingly very close to the last one that we saw with COVID.
Well, COVID was a different type of black swan event, one would have to say. It's it's in the category of natural disasters, basically. We've got enough out there. It's always in everyone's consciousness. Financial markets basically don't like to price in political risk, because there's a political risk there every 5 minutes. Um, so they basically don't price it in until the shooting starts, and until it becomes really ugly, because otherwise they end up with a very familiar cycle of people say, oh, but you need to watch out for this. So they get rid of some of their risk assets, they pile up the defensive assets, and then what they find out is that it doesn't actually materialize, and they end up having to buy back into the risk assets at 10, 15, 20% higher than they actually sell them at, and end up thinking, you know what, I should have sat that out. uh, so we've got the geopolitical tensions. We've got the whole national political tensions, whether it's in the US, whether it's in France, whether it's in the UK. We've got the global trade tensions with China. We've got the NATO versus the Shanghai Cooperation axis as well. So there's plenty of things out there which could definitely create a black swan event. Typically, I think what people need to remember with the interest rate cutting cycle, and I've made this point a number of times, we actually haven't had an interest rate cutting cycle, particularly in the US, in the last 25 years, i.e., since the LTCM Russian crisis, which was 97, 98, which hasn't been triggered by some sort of financial systemic threat. None of it has been there's been a normal one where the economy is slowing, we need to give a little bit more stimulus, and it's all very gradual. It's always been, oh my goodness, we've got a financial systemic crisis. We need to address that immediately, cut rates dramatically, and do more quantitative easing. And that's all people are used to in the last 25 years, particularly since, the last 15 years since the global financial crisis. So that's what the peculiar part of this is when we're talking about second guessing a recession. Any recession, even in Europe, Europe's growth is not impressive at all. Germany is going through a period of deindustrialization, but we're not talking about a crash bang wallop recession. The economy is not going to contract like it did in the first 6 months of COVID. It's a gradual stagnation, I think, rather than a recession. And for that, generally, interest rates don't do a lot because a lot of the problems are structural and therefore need to be dealt with by the legislature, i.e. fiscal spending and changing legislation, rather than this precious little central banks can do if an economy has a lot of structural headwinds. And a lot of the developed world economies do have structural headwinds.
We mentioned many macroeconomic factors on the show this morning. We talked a little bit about China, Japan, Germany, the elections coming up here in the United States. Just to round us up here before we wrap up, what should folks who are investing in crypto, whether that's on the ETF front or by actually holding the crypto or trading the crypto, what should they be watching right now as we head to the end of the year?
I think basically don't watch who's going to win the presidential election. Watch what how Congress is going to be made up. That's going to be far more important in terms of market reaction, because it will be, if there is if one of the parties wins both houses, then they have and assuming we have the president from the same party, they basically can do a lot in terms of legislation, which could have quite long-lasting impacts. If, on the other hand, Congress is divided, basically you're not going to get as many dramatic things. And the other thing I think people need to remember, which I think sometimes gets lost in the wash, particularly with regards to the US, there is this idea that the Republicans are more hostile to China than the Democrats. I would actually say the Democrats are much more hostile to China because they see China as a threat. In the words of Donald Trump from just a few weeks ago, the Republicans basically don't mind what China does, but if they want to sell things to the United States, then come and make them in the United States, employ American workers, and we will welcome the Chinese goods. So that's something to always bear in mind, because I think sometimes people go, oh, well, Donald Trump but it will be bad for Mexico, will be bad for China, and it's not necessarily the case.
Marc, thank you so much for joining the show and providing that insight. And thank you for listening to the show and coming on this journey with me to better understand the crypto markets. If you enjoyed this episode, be sure to subscribe to the CoinDesk Podcast Network. That's available on all podcast platforms. Give us a 5-star review, leave a comment about what you love or what you hate, and we will be sure to read them and respond only when appropriate. If you prefer to watch video, subscribe to our YouTube channel and hit that like button. Your support means the world to us. Have a fantastic day, and we'll see you on Monday.